Hey everybody, welcome back. James Phifer with ACCU, and up next I had a wonderful guest. Most recently, his name is Arthur Beisner, former friendly competitor turned M&A advisor. So we sat down and had an amazing conversation from mergers and acquisitions to what's going on in that role in community management. We talked about what it is to be a community association manager, the benefits, the pitfalls, and everything in between. It was a fantastic conversation. Want to go ahead and apologize in advance for some of the poor video quality as I'm getting used to running several cameras and hosting and producing all the content. It was not exactly perfect, but we're getting there. But what's most important is he was dropping such good information the entire podcast. So if you have the time, watch the whole thing. But if not, stay tuned because we're going to be coming out with segments of the most important and valuable things that he had to talk about. So Arthur, thank you so much for being on the show. And I'm going to be producing all of this video here very soon. So stay tuned.
Sure. Yeah. So my name is Arthur Beisner. I'm a business broker and an M&A advisor. Background in property management, HOA management for about 10 years. Sort of involved on the acquisition side for a couple of those years and found my way to brokerage. That's what I'm doing now. I'm helping business owners that are looking to make an exit, planning for that exit, figuring out their go-to-market strategy, and then ultimately finding the right fit, the right buyer, getting the deal done.
And what industries are you doing that for?
Really any and all industries. In brokerage, we focus more on Main Street. So the M&A space is kind of divided up into three sectors. You've got Wall Street. Those are the publicly traded companies. See that stuff on CNBC.
Yep.
You got middle market. Those are the investment banks doing deals, hundreds of millions of dollars. And then Main Street, which interestingly enough is 99% of all businesses in the country are Main Street businesses. And these deals will go up to about 20, 30 million.
On Main Street?
On Main Street, yep. So there's a little bit of an overlap between Main Street and mid-level market. Once you get into the 10, 20, $30 million range, you've got a lot of private equity companies that are coming down and saying, hey, especially happening right now in the HOA space, they're looking at businesses there. But typically with small businesses, 99% of the businesses in the country are doing less than 40 million in revenue.
So on private equity.
Yeah.
Are you doing acquisitions when private equity is involved, or how does that work?
So we represent the seller. When I'm doing a deal, I'm representing the seller and I'm taking it to market for any and all buyers. These are potentially individual buyers that have cash or are going to get an SBA loan, or they might be institutional buyers like private equity that are looking to do sort of a roll-up. Maybe they're buying a ton of HVAC companies, rolling them all up into one for the purpose of selling down the line 3 to 5 years. So really we take the business to the table, to the market, and whoever wants to bid can bid.
That's I think this plays into my market pretty hard because there's been a lot of private equity coming in and buying up management companies. And I think it's a big piece of what the industry wants to know a little bit more. And we're really curious about, how private equity really functions. And when I take a look out in the market and I see that Joann's Fabrics and that Party City and that, the list goes, Toys R Us, on and on. And looking at those companies and their profitability, they look like they were profitable on paper, but what I can see what happened in certain situations with private equity, they come into Toys R Us, they sold the real estate asset underneath them to a different division, charged higher rent, and then started stripping it away, essentially offering less goods and less development, and eventually got to the point where it went upside down. And I don't know if that's always the case with every private equity acquisition, but it does seem like private equity is involved for a purchase later on. I don't know if you see it that way or if you have any insight onto the dealings of private equity.
Yeah, so your typical buy and hold in a business setting is your buy and hold is the business owner like yourself that either starts a business, buys a business. You're working that business for the rest of your life until you're ready to exit.
Right. Yeah.
What private equity is really doing, and a lot of people will sort of refer to them as corporate raiders. I'm sure you've heard that term.
I have, yeah.
That's not entirely fair to say about all private equity.
I didn't think so. Like one management company is going to be different than another. I think that's all business, right? So not everyone's a corporate raider.
100%. There's good, there's bad, there's in between. But typically what private equity is looking to do is they're looking to come in, buy a business that's sort of got steady growth potential. And this is where we again kind of differentiate between, this is happening a lot in tech companies where you've got venture capital, high risk, high reward, 9 out of 10 deals is going to fail, but the one that catches makes people billionaires, right? Venture capital.
Yeah.
Then the other end of the extreme, you've got sort of low risk, but much lower reward with private equity. You're looking for stable businesses, mature businesses that have been around for 10, 15, 20 years, usually, that have a management team in place, that have consistent revenue, no serious concentration issues, and they're looking to buy that business, hold it for 3, 5, maybe 7 years, flip it on the market, usually to another private equity firm, or an investment, or using an investment bank to find a larger corporate buyer and get a moderate return for their investors. So these are private funds.
Is this before it's public?
This is before it's public. Yeah.
How big do you have to be before you go public? Because, I mean, this sounds pretty big at this point, right? Because you had private equity that purchased the mom and pop shop.
Yep.
Private equity bought it. They're going to grow it, probably through other acquisitions, right? Now they're interested in selling to either a bigger PE group or a corporate interest that has the availability where they need cash flow like that in their organization, right?
That's right. Yeah.
Step after that public, usually?
For some companies just never want to go public. Some companies, it's just not really in the cards to go public. I think that, Wall Street is accessible to everyone. Private equity is not. You usually have to have a pretty high net worth, a lot of funds available to put with a fund to really reap the rewards that private equity can get. And so oftentimes private equity is going to flip to either a larger PE firm or another PE firm, or sell part of their stake in a company to another PE firm, or sort of a corporate strategic buyer. What you're seeing private equity do a lot right now, and this goes back to the HOA space, what's happening all over the place. There's a term roll-up, I'm sure you've heard, where these private equity companies are backing what's called a platform company. Platform company has good software in place, good systems in place, they have good SOPs in place, they have a good management team in place. And the idea is, this is our platform, and we're going to go out and we're going to find all the mom and pops that are worth taking a look at. We're going to acquire those mom and pops, roll them up under the platform company. Essentially, it's a huge play for market share. And then once they're ready to go, once they're ready to divest, there's these large national or regional firms that want that market share, and they're going to pay a really high premium for it.
And that is what we're seeing right now. And I'm not used to the new game that is being played. And obviously, as an independent operator, it's a little scary. Additionally, I mean, I get hit up at least 3 times a week on minimum from companies that I'm aware of that are operating in the space, and companies that seem like they know nothing about what I do, but interested in the purchase. And I'm like, there's something about management companies that is very, very attractive to whoever is out there wanting to invest. And so since 2020, the majority of the friendly companies that I was competing against have now been purchased and are operating. And it frustrates me because when I go out to bid, they're still operating under the name of the old company.
Yeah.
And I know that, I don't know if the term here is rolled out, but they've been purchased, by this parent company, and I'm bidding against this essentially the same company. It feels like, they're all different names, but it's the money's flowing one direction. And I'm like, this seems slightly unfair.
So there's a lot to unpack there. First, let me hit why people are looking at the HOA industry, specifically with private equity firms. I think that there's 3 reasons. The first is you've got annual recurring revenue, actually monthly recurring revenue. You charge management fees every single month. Those cover your overhead, your operations. You might mark some things up. You might charge extra for, different management companies do different things, right? So some are going to make their gravy in terms of maintenance and construction. Some are going to make their gravy in terms of charging markups on stamps. the whole gamut.
Mhm.
But the one thing that you have that a lot of industries don't is that recurring revenue. And anyone loves recurring revenue. Just set it and forget it. Another reason is I think the potential for construction work. You see the prices right now of goods and materials. You see the prices right now for labor. Tariffs aren't helping. Like, prices are going sky high for anything construction. If you look at the HOA industry, the last time I looked, I think it was the 22 or 23 data that a research organization put out. It's like an $11 trillion market in terms of the maintenance assessments that are collected every year from HOAs across the country.
$11 trillion.
$11 trillion in maintenance assessments annually. Now, fact check me. I'm not 100% sure if I've got that right, but
I think it's good for this conversation, right? Like 11 trillion, that's a ton.
well, you look at your average HOA budget. Now, unless you're dealing with the super high-end high-rises out in Miami Beach or New York, a lot of that money in those situations is going to, amenities, hiring pool staff, valet, things like that. But for your average HOA in the country, what's that money going to? Primarily, it's repairs and maintenance, right? You've got management costs, you've got administrative costs, you've got insurance. Obviously, insurance is growing.
Insurance is largest, but you're not wrong. It's maintaining these properties that is one of the biggest expenses, which is to your point. And they're seeing the money that's flowing from these budgets to maintenance costs, and they're realizing that there's a capture there.
And you bring in the insurance factor too. And if you're in a place like Colorado, you're getting smoked by hail. You've got a number of associations that file a claim every single year. Roofs are not cheap to replace, especially if you've got a big garden-style HOA or townhome community. It's a pretty big project. And there's a lot of money to be made in insurance claims, whether you're the general contractor, maybe the management company, even the insurers somehow make off with money during that process. And there's just a lot of money going around. And in my opinion, James, the HOA industry has been overlooked for a long, long, long time. And right now it's starting to get a lot of attention from some of the more institutional investors. Your monthly maintenance fees, the potential for construction revenue, but then the third thing. I think that this is the gold mine. I think that this is really the long-term play that a lot of these companies are looking at. The data that you've got as a management company owner and the data that all the management companies together have of homeowners, how much they're spending in terms of their home maintenance, how much these HOAs are spending in terms of their home maintenance, all the data that you've got at your fingertips, that's, data is the new oil.
I don't have enough data. I probably do if you're looking at our company for an acquisition to add to the portfolio, but I can't say that I have reasonable availability to profit off of that. But it sounds like, and this has been my take on it for a long time too. I see majority of companies that are starting today offering a service. That service is tied to getting at the data that is behind the curtain, and we try and hold that close to our chest as possible. The first person that gets access to data that gets them all of the board members and then can turn around and sell that information to companies like me wins, right? I mean, that type of information I think most of us would pay for, because right now they're volunteers. It's very hard to find who it is that I can market to. Associations are non-solicitation, so you do not go to communities and knock on doors. Little history here. Before that happened, my old man got to sit in the nice warm car when my brother and I ran stairs and put the door knockers on all the doors when we were kids, right? And
been there, done that too.
Right. So we're the reason probably that was no solicitation anyway. Kind of funny story. But you can't solicit to them on site. You don't really know who they are. You can go to a property and look for meeting minutes that may determine who those board members are, but that is time-consuming effort. to drive around, to look for it, and the event that they may be unhappy with their management company. But the second you can really distribute things at mass, you win. And so then that's just one small piece of the data that would become valuable. I mean, if you have all the homeowner information and if you're using that to your advantage, I can imagine that the money that you could make per door 10x's over traditional management pretty quick. I don't know what that looks like because I don't play in that world, but it seems like that is the race today is for who controls the data.
Absolutely. And you yourself as the owner of ACCU, you may not have that much data that could get you tons and tons of money, nor would it necessarily be right to sell that data.
Sure.
Right? But if you are acquired by a larger company that was acquired by a larger company that was acquired by a larger company, all the way we go up here, and you're the private equity firm holding a controlling interest in that company, you've now got access to more data than you know what to do with. So there's a lot of reasons why the HOA space is getting a lot of
mind-blowing.
Yeah. But I think that those three really are the big thing.
So you were in, you and if I understand it right, your wife were both in the HOA world, and as I understand it, she was like one of the best in marketing when it came to the HOA space, and just really knew how to knock the ball out of the ballpark. Were you on the management side? Were you on the accounting side? What was your role when it came? Because I know that you were doing acquisitions and things like that at some point, but you held a role of manager or accountant at some point, right?
Yeah, so I've done almost every role in the industry. I started when I was, I think, 19 years old at a high-rise in Miami Beach.
Okay.
In an operations customer service facing role. Then I became an administrative assistant, kind of focused more on the accounting side of things, so I was able to learn accounting well. Became an assistant manager, then ultimately took over that building as the general manager for a few years. It was a big building, learned a lot, did a lot of different, everything HOA management you can think of was under that roof. COVID hit. Completely changed the game, especially when you were in high-rise management. You went from doing financial management, operations management, construction management, team leadership, everything, to crisis management. And, don't kill each other over what's going on right now. However you feel about it, don't kill each other. And so at that point...
Because of politically divided in the property.
Yeah. Oh, yeah.
Sure.
So I would have residents almost physically fighting each other because someone touched the elevator button. So I had residents that would fight each other over who was wearing a face mask, who wasn't wearing a face mask. And there was actually a resident that called me wanting to know who on her floor had either contracted the virus and or who had been vaccinated. I'm like, I'm pretty sure this is a violation of HIPAA, but...
And then it wasn't, right? Because didn't like Apple all of a sudden start like...
Well, Apple could do what it wants, right?
Yeah, I guess so. We're talking on a different level, but now that you're bringing that back up, like I'm reliving that whole scenario. You're absolutely right. The amount of people that were just either, I'm an American and I'm free to do what I want, and you will wear a mask because the government tells you to, and like just the tension was growing to a boiling point. So you're in Florida. Yep. You're managing a high-rise. COVID hits. This is out of control now. What's next?
Yeah, so realized I didn't want to do that anymore. My wife and I had came out to Colorado to vacation, fell in love with it. Florida boy, born and raised. Well, not born, but raised in Florida. Spent my whole life there. I was just ready to get out. So I started looking for a job and found a company. It was a startup at the time, and they were looking for a management director. So I was like, well, this is great. I can stay in the industry. I know the industry well. It's really the next step in my career ladder. So I went for it, joined the company. They were not from the state, but they had acquired a couple of companies here in the state. Well, little did I know until I got out here, boots on the ground, that the role of management director was partly true, but that there was a lot more going on. Because I had found out once I came out that they had acquired these two companies, and basically they needed someone to do what in our industry we would call acquisition integration. So you buy the company, you get the systems changed over, operations changed over, all of that's involved in the integration, the transition post-acquisition. But really the most important thing when you're buying a company, selling a company, for the acquisition to go well is the clients and the culture. And so they needed someone to basically hold together the clients and transition the clients onto the new contract, the new system, and then someone also to kind of run the team.
So I can see you being a great personality for that role, by the way, right?
It was fun.
I bet.
Yeah, it has challenges, but it was a good role, and it really opened my eyes. You know, obviously running the market for this company, but also getting to see under the hood of what goes on in these acquisitions. It was a really, really good experience. So I did that for a couple of years. Then I moved into more of a sales and marketing role. So I was very, very heavily involved on the marketing side. You know, what you say about getting board member data is absolutely true. You can spend a lot of time. Data is worth everything. And spent some time on that. And then the company that I was working for ended up getting, interestingly enough, private equity. At which point I realized, you know, saw the writing on the wall. I'd been a part of a couple acquisitions on the buy side. Now there was an acquisition happening on the sell side. Did not want to be a part of it. So found my way to brokerage.
And that's one of the questions I was kind of getting at, because I think a lot of managers who are looking at entering this as a career choice want to understand a little bit more about what is it to take this job, and maybe why some people decide to leave the career.
Yeah.
And that's what I want to give to the community, is making sure that people decide to take on a role as community manager. If you were to give them like a 30 to 60 second rundown on what the career is like, and then another 30 to 60 seconds about what are some of the pitfalls and the reasons that people leave, what would you say?
Oh man, you're limiting me on my time.
You know what? No time limit. No time limit. Just
right.
give me both sides of that, and let me know what your thoughts are on that.
Yeah. So my advice to someone entering the career or thinking about entering the career: don't take yourself too seriously. What we do is a serious thing. Community management's a really important job, but you can't take yourself too seriously. You're gonna have people screaming at you for something that you never did, or something that you did that they didn't like, and it doesn't really matter. And the minute you take yourself too seriously, at the risk of sounding careless, if you take the job too seriously, you're going to burn out, and it's a real thing that this industry goes through. What I learned early on in my career, and I think this is true to life in general, I would say that probably 80% of every problem, 80% of the problems that you face in life, they say time heals all wounds. 80% of the problems will be fixed simply just because they fix themselves, because they're not real problems. They're not problems that really deserve attention or a solution. Now in community management, I'm going to say that's not 80-20. I'm going to say that's like 90, 95. 95% of the problems that you face, that you think are these big, big problems that homeowners have you chasing rabbit holes, will fix themselves. I mean, even weeds will die at the end of the summer. Now, I'm not saying don't enforce the rules, but, you know.
You bring a solid point.
Rules are meant to be broken. Actually, no. Rules are there to protect the association if and when they're needed to be brought out.
Yeah.
It's my opinion. But most problems will fix themselves. And when you're caught up in chasing down problems that will fix themselves, you are too distracted, you're too burnt out to deal with the real problems. Hey, are we funding reserves? This insurance claim that happened, how do we deal with that? How do we manage this capital project? We really need to convince the board to do more than a 2% cost of living increase to the budget. The real problems that you need to get your hands dirty with, you're going to be distracted and you're not going to be able to do it. So don't take yourself too seriously. It's a fun job. It can be a very stressful job. You can feel like you're being pulled in a million directions, but you've got to come back to what's my role here? What's the purpose? What's my why? Why am I a community manager? What is the true job of a community manager? I would also say that, you know, as you're being As you're being pulled in a million directions, cutting out the noise is really, really helpful. And just getting back to basics. What's your actual job? The other thing too is you learn a ton. So if I were to advise a young person, don't go to college and go into college debt to get a business degree. Become a community manager for 5 years. You'll get paid, hopefully handsomely, to learn everything you need to know about a business education. You learn finances, you learn negotiation, you learn construction, you learn real estate. The most important thing is you learn human psychology. You learn the fact that even though the community Karen, excuse the expression, but even though the community Karen is blowing up your phone and angry about her neighbor not putting the recycling bin away, it's not really what the problem's about. There's something deeper, and it has nothing to do with you. But she's conveniently able to bend your ear for a little bit.
I love that analogy of because you're absolutely right. The opportunity that we have to work on legal issues with lawyers that are representing the association, the relationships that we build with business partners and contractors, and understand things from landscaping to roofing projects. You understand the world around you much more. Sometimes it's hard to go on vacation because you're sitting in the lobby and you're looking around and you see things that you didn't see prior to being a community manager. Getting a education and finances, building budgets for these associations, being responsible to those budgets throughout the year, and how to maintain, like, that helped me out so much in my own personal life to understand this is how a community runs its finances. This is mirroring the way that I should be behaving, right? And where are my bad habits and what am I doing well? So your analogy right there about don't go get a college education. I'm not saying don't. I don't know how valuable they are, but
look, I dropped out of college after 1 year. It wasn't for me. It's for some people. I think if you're going into you're going to be an engineer, you're going to be a doctor, you're going to be a lawyer, you kind of have to because that's the way it's set up right now. But I dropped out of college, and I can tell you right now the foundation that community management gave me. My day-to-day right now is I'm reading financials, doing financial analysis, I'm dealing with attorneys, I'm dealing with CPAs, I'm dealing with a lot of stakeholders, lenders, I'm dealing with real estate. I'm negotiating, and everything you do in life is negotiating. Everything that you're doing as a community manager, you are negotiating. You're negotiating.
All right, everybody, as stated before, a couple of filming issues on this one, so thanks for hanging tough with me. All right, keep watching.
all right. So in acquisitions, when a management company is looking to sell, tell me a little bit about what that process looks like for the owner from the start of receiving the phone call on acquisition to post-closing. Tell me a little bit about what that looks like.
So, and you've experienced it too, getting 3 calls a week from people that want to buy your company. It's outside person, private equity firm, or hands down, can I drop names on the podcast?
I'll edit them out if I feel like it's not great.
Perfect. There's a damn good chance that has called you, someone called you, someone from has called you. Like some of these big national firms, they're trying to acquire everyone. So as a business owner, just in general as a business owner, throughout any industry, but specifically the HOA industry right now, you're getting hit up all the time to sell your company. Now, the good news is that if you're at a point where you want to exit, in the HOA space right now, prices are really, really inflated. People are paying way too much money shouldn't say too much money because it's not too much money for a business owner, but they're paying well over market value for the HOA companies right now because ultimately it's a market share play. And as we talked about, it's really a data play at the end of the day. So it's a good time to exit. If you're a business owner, especially we've got the baby boomer generation that's retiring, you are one of a kind in that you took over, you stayed in the family business. Most people don't want their family businesses anymore. And so tons of buyer activity in the market right now. A lot of private equity activity here in the HOA industry right now. Good time to sell in terms of the price you can get for your business, but a bad time to sell if you don't know what you're doing and if you don't have someone representing you. And we can get into some of the stuff that is going on behind the scenes with these acquisitions. But to answer your question more generally, what you can expect is someone's going to submit an offer to you. Now, it might just be the perfect offer, a unicorn offer, and you're saying, hell yeah, I'm going to take this because I'm going to be on the beach in Cabo in half a year. Great. More than likely, there's going to be some negotiations and back and forth on that offer. You're doing yourself a disservice as a business owner if you're not getting multiple offers. So calls you up, says, hey, we're going to offer you something for your company. We want you to come in and be one of our brands. Great. Well, now you need to turn around and you need to go to a bunch of other companies and say, hey, I've got an offer on the table, thinking about selling, come to the table and offer me something. Once you've got an offer you like and you're ready to move forward, that's really when the rubber meets the road. We get into due diligence. What happens during due diligence is the company that's thinking about acquiring you is going to be looking through all your dirty laundry. They're going to be looking through your tax returns, your financials, your balance sheet, profit and loss. They're going to be asking a million things from you. They're going to want to see client list. They're going to want to see contracts with every single client. They're going to want to see any lease agreements that you've got. They're going to look under the hood and know everything about the business. The more institutional the buyer or investor is, the harder the due diligence process is going to be. It's a full-time job, and you're going to be pulling your hair out trying to get this due diligence done while you're running your business. You've got to keep growing your business. If this company sees sales declining during the due diligence process, the offer is going to get amended. If this company sees your profit margin going down during the due diligence, you might say, well, I've been working so hard on getting you all these documents and asking and answering your millions of questions, but if the business suffers at all during that process, there's going to be what's called a retrade at the end of the day, which is a couple weeks before close, maybe a couple months before close. What happens? The company says, hey, we looked at your year-to-date financials and what happened to sales this year. And they're going to pull maybe some from the purchase price, or maybe put some of that cash that they were going to give you at close and put it into an earnout, which is one deal structure that we can talk through. Bottom line, due diligence is a really, really stressful time. There's a lot of work, a lot of stuff that you've got to get through until finally you close on the transaction. You no longer own your company, and you get paid a lot of money in theory, because now you're rich. You sold your company, inflated values. You're going to go sit on the beach in Cabo. It's great. But what do you mean, but? You just sold your company. Except for the fact.
This was every company owner's dream right here, is that you get to the point where you sell, you have your money in the bank, and you're on the beach.
Except.
But.
The business that you run as an HOA management company is a service-based business that is 100% contingent on the relationships. To make it more complex, just because you have a good relationship with the board you have today doesn't mean you're going to have a good relationship with the board that gets elected this fall. And so there's a lot of complexity to this. And so as a management company owner, the chance of you being able to sell your company, wipe your hands, and walk away, sit in the beach in Cabo with the millions of dollars you just made is very, very, very low. Why? Well, there's a lot of risk in it for the buyer. And I've sat on both sides of the table, on the buy side and on the sell side, and the truth is there is a lot of risk in it for the buyer. And so the buyer is going to do anything that they possibly can to mitigate risk. What's the risk for the buyer? The risk for the buyer is day one, to close the transaction, you're out the door, and now clients start leaving one by one because they don't like the new model. They don't like the new company. They never asked for this change. Your employees start leaving one by one. They don't like the new director that you put in place. They don't like the software that you're using, whatever it is. They start leaving one by one. And there's a very, very high risk because of how relationship-based this business is. There's a very high risk that within a year of acquiring the company, you could have just washed a lot of money down the drain because you just had 100% attrition and there's nothing left. You've got a copier that you got from the acquisition, and that's all you've got left. So buyers, it only makes sense, buyers are going to do things to mitigate their risk. Now, as a seller, what you can do to mitigate the mitigation of risk from the buyer's perspective, what you can do as a seller is put together an exit plan. An exit plan says, I want to exit in 3 years, 5 years. What are the things that I need to do? Number one, the number one risky issue for a buyer is owner dependency. And so this is a good litmus test. If you can't completely disconnect and take a real vacation, not a remote work vacation, a real vacation from your business for 1 month without sales declining, without losing clients, without losing employees, without anything bad happening in your business, if you can't do that, you're not ready to sell.
I love this, and I have a couple questions if I can jump in real quick.
Please.
Company A, management company A, management company B. Both have 100 associations, right? Management company A has had maybe 10 associations leave and 10 associations on, while management company B has only grown by 2 communities but hasn't lost any, right? Management company A has an owner who nobody can do it better than me. I'm the best, and so I manage our top clients, and I handhold all of them. Management company B has decided to step out of that role completely and has since had somebody else come in. Management company B is not able to show as much in profit, primarily because they've hired that person, where management company A, because he's doing a majority of that work, is showing a higher profit. And as you said a second ago, if the person who's managing all the communities is also doing all the sales, and management company B has somebody else who is doing the sales but not showing as much of a profit because they have more people, which one's more desirable from the buyer's perspective?
It's a really good question, and it kind of depends on the buyer. If you're looking for someone who just wants to step into your shoes and is looking to buy themselves a job, which doesn't happen that often, but it does happen, then management company A is great because you can see that the owner's getting paid a hell of a salary and taking all the distributions. Most acquisitions in this space do not happen from outside people. Most of them are strategic. The large companies, the national companies, private equity-backed companies acquiring. In which case, company B is a much better option. Because these companies, number one, their number one driver is not increasing their EBITDA. Their number one driver is increasing their market share. And they've already got systems built into place where they're going to go through your financials and they're going to say, we've already got this cost taken care of, and we know our door rate for this particular cost of goods or particular expense and overhead. And so it's simply a calculation on their end to say, if we took all of these accounts and all of these employees on day one, what would our cost be? And so it's going to be ultimately more profitable for them, but it's a market share play. It's less risky for a buyer if the seller, if the business owner, is not involved in day-to-day operations. Because especially when the owner's not involved in client relations. What happens all the time, and this is really, really important for business owners that are several years out from exiting their company to understand. If you've got client concentration issues, where 25% of your revenue is coming from that one master association that you've got, which, yeah, it's great for you because it pays you a lot of money, but that's going to be a ding in terms of the risk assessment from a buyer. But if you are managing properties, if you're doing all the sales, if you are in the weeds day to day, and the business can't function without you, what's going to happen? You're either going to get a much lower valuation for the business, which doesn't help you sit in the beach in Cabo, or what's going to happen is the number one way to de-risk one of these transactions for a buyer, specifically one of these strategic buyers, is a little tool that we like to call earn-out. So what's an earn-out? Well, I'm kind of taking you down the rabbit hole of M&A and deal structure. When you buy a business, you've got a few different tools in your toolkit to put the deal together. Cash is king, cash is great. I wish I dealt with only cash buyers. That's not the reality of the situation. Then you've got bank financing. Bank financing is expensive. Now, if you're private equity backed, you might have some financing, some debt financing in there, but typically it's going to be funds from investors that's being used in the acquisition. But debt is expensive and it's also risky. And then you've got the sort of the non-cash elements of a deal structure. The primary one of which is called an earnout. So what is an earnout? An earnout is basically saying you sell your company for $1 million, they give you $500,000 down. Instead of putting the remaining $500,000 into a seller's note where you're guaranteed that money plus interest over time, what they're doing is they're saying, look, this is a risky purchase for us because if you walk away, then we're losing potentially 20% of the clients, in which case we don't want to pay what you've asked us to pay for the company. So we want you to put your money where your mouth is, and we want you to stay on as an employee, director level, maybe you're doing sales, maybe you're doing director, maybe you're doing whatever. But you're going to stay on because we need you, otherwise we might lose clients. And over a period of 2 to 3 years, maybe 5 years, whatever, we're going to pay out the rest of that $1 million purchase price to you if retention goals are hit, growth goals are hit, margin goals are hit, whatever the agreement is there. Now, earnouts are a really good way for a really good tool to de-risk a transaction for a buyer.
De-risk transaction for a buyer, but from my perspective,
yeah.
Sorry to jump in, but I get nervous about a rug pull, right? If I understand, if I like private equity well enough, and I don't think I do, but I would be looking at some of my largest expenses, and one of those is buying the companies, right? And if I have this rollout scenario, I'm going to come up with a team that's going to look at what rollout is, what I can put on the owner now that they're my employee and they have this risk out there. And I'm going to say, okay, not only are you responsible for making sure nobody leaves, but you have to meet all of these new requirements that weren't part of your job responsibility for because you're going to be proving to me. So now, as an owner, I'm working twice as hard for not as much in hopes that I'm going to earn this like money over here. But I feel like they may structure the paperwork to make the losses look a certain way where I get rug pulled. And I'm
very
like,
astute observation.
And I'm like, the other management companies that have sold will leak to the market, I made 12 times earnings on the sale, or whatever, right? They're always trying to one-up each other in this business. It's probably business in general, right? I sold my company for more than you sold yours for, ha, ha, ha.
Yeah.
But did they receive the full rollout?
That's a good question.
But they're not coming back and saying, I know I told everyone that I got 12 times earnings, but, at the end of it, I only made whatever, right? Yeah. And so I get really nervous when it comes to those thoughts. And you do this for a living now, right? Like you get with business owners and you help them come up with a strategy, help them understand where they need to either be involved or be less involved to make their companies more valuable upon sale, and then help them structure a deal where they can feel confident when they go to sell. Because this whole scenario keeps me from wanting to talk to anybody. And don't get me wrong. Number one, the reason I don't sell is because I'm enjoying my career. I'm raising my family. I like what I'm doing. I love my employees. Like there's a lot of different reasons. But when they're telling me the money that they're going to buy me for, it's tough.
Did you read the fine print though?
I really haven't gotten that far, to be real honest. Just because I'm not interested, my clients need a local management group that they can come to. And if we all leave, there's no options out there. And I just do not see enough young people wanting to own businesses anymore. I think they have a term for it. It's called like skating or something like that. They'll go work for a company. They're going to do this job and they'll leave this job for another one that pays more. But like, I feel like when we were younger, we were all hungry little shits, right? Like we wanted to get in there and make money and own, and and I just do not see that. So if I exit and we don't have independence anymore, where does that leave our clients? And so I think that's one of the main reasons that I decide not to move for now. But at some point in time, I have to come up with an exit plan. I'm not going to live forever. So there's that rolling it over to my employees. And I mean, that's an acquisition. There has to be plans there. You got to have a professional that understands how that's going to work. Are you going to sell to somebody who wants to own a business right? Or is the option only at that time to sell to a larger company? These are all things that business owners today are going to have to understand at some point. It sounds like you really have some insight because you've been doing this for a while now, and it sounds like you understand what's behind the curtain.
Yeah. What's behind the curtain is absolutely right. And just to go back to those options, I mean, there are a lot of options on the table. Even in an employee, in fact, I think Colorado is like the first state to do the employee stock ownership plan, which you have to hit certain a certain criteria, like $1 million in EBITDA, to qualify for this. But there are plans where, as a seller, you can get serious tax benefits by basically selling the business to your employees. That's another conversation for a different day.
No, I love that though. And I'd love to do that because that sounds fantastic.
Yeah. But typically, you're looking at either an institution, whether that's private equity or a strategic competitor, or you're selling it to some guy off the street. And the strategic acquirers come in different shapes and sizes, right? You've got some of the local guys. Like if you're managing 200 communities locally, you can probably afford to do an acquisition for a 20 or 30 HOA business. If you're managing 10,000 HOAs nationally, then you can afford to acquire one of the bigger regional players. And so it scales up like that. But so back to the earnout. What's behind the curtain? What's in the fine print? 12x EBITDA is great. Are you really taking that cash home? That's the real question. And so what'll happen is, and by the way, as a seller, the best thing that you can do to mitigate a situation where you might be tied to a rough earnout is getting your business ready for that exit. Get yourself completely out of the operations. You don't want your clients to know your name. And that can be hard to stomach for a lot of people in this business, but you don't want clients knowing your name. You want your business running such that you can take a half a year off, and then you're going to get that unicorn of a deal where someone's going to come in, they're going to pay cash, maybe they'll use some financing, but at the end of the day, it's all the same to you. You're getting paid cash and you're done with the business. It doesn't happen 99% of the time. So what does happen? You sign an earnout. The earnout says, I'm taking $500,000 up front, taking $500,000 over 3 years. Now, I just want to say this, an earnout in theory is not bad. It's a tool in the toolbox. And I actually really like earnouts if and when they're used as the way they should be, which is a value gap. What do I mean by value gap? If you think your company, and one of the hardest parts of my job is having conversations with business owners and saying, yeah, your company isn't worth $5 million. It's really not. But if you think your company's worth $1 million and the buyer only thinks that your company is worth $750,000, that's where an earnout can come in handy. Because you can say, well, I want $1 million and I'm willing to prove to you that it's worth $1 million. I'm going to put my money where my mouth is. So pay me the value of my business today as you see it, $750,000, and then I'll earn out that remaining $250,000.
Interesting. I like where you're going with that. Okay.
It's good. It's a good tool for a value gap. And I will concede it's also a good tool to mitigate risk for a buyer. And you see this a lot with service-based businesses, CPA practices, for example. If you sell your CPA practice and all your clients leave, well, you just wasted all this money as the buyer. And so there is a need to mitigate the risk on the buy side. But the earnout has to be proportional and it has to be fair to both sides. A lot of times I see an earnout done off of EBITDA or net profit or net earnings, right? Well, that's, as you mentioned, pulling the rug out. That's really unfair to the seller because you can come in and you can blow up that marketing budget. You can blow up any line item and all of a sudden you just reduce profit so substantially that now the seller doesn't earn a cent of that earnout, but he still has to work for you. Flip side of that, you can also do an earnout if the seller's capacity is going to be in a growth capacity, sales, marketing, things like that, and you do an earnout based off of gross sales. That's really unfair to the buyer, and it skews in favor of the seller. Why? Because the seller can go out and just sell any kind of account he wants, the most low margin, terrible accounts that actually end up hurting the company. That's not fair to the buyer. So a good thing is to do an earnout based off of gross profit. It means that it's the most middle of the road there is, because you're incentivized to grow the business, and you're also, the seller doesn't lose the earnout if you squeeze profits as the buyer. In the HOA industry, most earnouts are going to be based off of retention. Because what are you buying in an HOA company? You're buying the book of business. You're buying monthly recurring revenue. You're buying the potential to make money on construction and stamps and all of that. Typically, you're going to see an earnout built some way, shape, or form around a level of retention and growth. Well, here's what can happen. And I've seen this happen, and this is the behind the curtain thing. We talked earlier about board members really, really disliking change. They don't like software change. They don't like operations change. They don't like manager change. If you buy an HOA company and tell the business owner you're going to get half of the purchase price if you can stay on as the director and keep 90% client retention over 3 years, you'll get paid out the rest of your purchase price. And then day one comes, and they outsource accounting to Mexico. They outsource customer service. You can no longer talk to your manager. You used to have the accountant's cell phone, and now the manager can't even talk to accounting. What's going to happen? You're on a 30-day contract, 90 at most. Clients are going to leave. So what happens? The business owner just sold their company, thinking they're making millions of dollars, tied themselves to an earnout. Company comes in day one, completely changes operations through no fault. I mean, you kept these clients for 20 years, happy. And now suddenly it's your fault that they left after the acquisition? That doesn't make any sense. And so what can happen, and I don't want to put everyone in a bad light, but this does happen, and I've seen it happen. You'll buy the business, make crazy changes day one, and then you'll lose half the book of business. Come down, have your attorney in tow, have a conversation with the business owner and say, hey, you didn't hold up your end of the deal, you're getting fired, and we're also not paying the earnout. So you just sold your companies for pennies on the dollar. You lost everything you worked for. You got fired to add insult to injury. And that's not a Cabo vacation happening. That's you go find another director job at a management company.
I'm trying to say as quiet as possible, so I don't cut you off. But that is insane.
But if you're running your business and you're managing clients, you're running your business, managing clients, managing your employees, doing all of this, and then going through due diligence, you probably have I'm sorry, but you probably have a scumbag attorney that's billing you by the hour. Nothing against attorneys, a little bit against attorneys. And you don't have someone on your side that lives and breathes this stuff and knows where the bodies are buried and knows what to watch out for, someone who can negotiate for you. You're doing yourself a serious disservice, and you're leaving so much money on
All right, so if anybody watching this has a want to talk to you about getting ready to sell their business, how do they contact you?
Yeah. Reach out to me. My name is Arthur Beisner. You can call me. My cell is 720-786-6223. Text me, call me, or shoot me an email as abeisner, that's Beisner, @tworld.com.